number one mistakes seed companies make is actually starting too late.
When do you start the fundraising process?
So you raise capital when the company is in good state?
Yeah, when the sky is clear.
Every company is good at a certain price.
What actually happens behind the scenes?
Getting external investment shouldn't be something for you to survive.
Now, how is the outreach organized?
You shouldn't do it when you need the money.
However, in Europe, it's usually 9 months. So basically, it takes us much longer here.
You're absolutely right. You have to do the preparation. You have to do like a very large funnel and then follow through with it.
Force them to say no.
You know Silicon Valley, the movie where the guy was saying, you don't generate revenue. The moment you have revenue, you have multiple.
You want smart money investors, and you need to know what do you need.
We were looking for 3.5 million. This was the target. From investors who were ex-founders. So they had founded businesses before. And there were a couple of other stuff. And then when the wrong investor looks at this slide, they're like, this is not for me.
How do you choose the right investors?
Super important that you feel comfortable for these people to sit in your board.
The investors that I think I want to do a deal with, I start speaking to the portfolio companies. Hey, it happens. Horror stories in startup world are a lot.
I like them so much that I'm going to give the 15 minutes every time to tell some other founder, this is the right investor for you.
If the founder doesn't take the call, it's a signal. Sometimes those calls turn out into an opportunity to get introduced.
Let's talk a little bit on the mistakes.
I've been extremely direct with VCs, and this was not very helpful. There are right answers to every VC question.
It's a filter for investors. They want you to give them the right answer. For me, it's a filter because if they don't understand what I'm doing and they don't back me on the steps that I'm saying that I'm going to do, they don't fit in my cap table, so they probably don't belong there.
And throughout every interaction, those questions need to boil down to the single question. Am I investing in this or am I not investing?
It's a sales process, and every salesperson knows that you have to learn how to accept no.
You have to be, confident but kind, aggressive but humble. You have you have to show all of these sides of you in 30 minutes.
You're not getting a new boss, you're getting a partner.
The one thing that we didn't touch upon, and it's really, really important for the people that listen. So for founders, be extra careful about the terms you agree to. There's a famous VC saying, you can write the valuation if I can write the terms.
A good investor is?
Let's circle back.
The Recursive RoundTable. 3 voices, 1 idea to decode the future.
Hello everyone and welcome to the Recursive RoundTable. For today's discussion, we have a great, strong, evergreen topic, and this is fundraising. And we have some amazing entrepreneurs with us, startup leaders, to share their fundraising experience and personal journey. We have Iliya Valchanov from Juma, previously known as Team GPT. We have Konstantin Bezuhanov from Evrotrust and Stoil Vasilev from Paypercut. And let's start with the big picture and the fundraising market and key trends in Central and Eastern Europe. Can you share your observations? How do you see the market? Is there enough capital? Which industries will remain hot? Maybe, Konstantin, you can start.
Yeah, I usually say that there's always money for the startups that are seeking it and who are performing well enough. It's just within the different periods, the bar rises and lowers on what are the standards for that. Of course, it's super evident to everyone that the really hot topic right now for the last couple of years is artificial intelligence. And last time I was looking at the data, about 66% of the global VC money actually goes to AI and ML, which means that if you're not doing anything around that, it's becoming even more difficult to actually raise money.
But everybody is doing AI now. Everybody is weaving AI into whatever they are doing. And they're saying, yeah, we are an AI company with, angle towards, let's say, fintech. I think that's a trend that, you can't get around.
Yeah, I think there's difference between having an AI feature and being an AI company. And having the AI feature, it's, as you said, everyone is doing it. It's not a differentiation anymore. But being an AI company, it's becoming a bit different. So just plugging it into a bunch of processes, into features, it's in my opinion, it's not exactly the same. But maybe Iliya can say, being the AI company here.
We actually fundraised a year and a half ago. I started fundraising 2 years ago. So my data is super outdated. And but what I've heard from other founders is that currently they're looking for these unsexy AI plays, meaning AI in supply chain management, AI in some industry that nobody usually builds startups in, right? So I think these are very hot right now. For companies like ours, it's becoming increasingly difficult. 2 years ago, it was much, let's say 2 years and a half ago, it was extremely easy. 1 year and a half ago, it was extremely easy. Right now, the bar is very high for what an AI company is. And because there's so many of them, nobody knows which are the good ones. So it becomes harder for everybody, I guess.
And I actually wanted to fill in as well something else. Everyone, and we did literally just jumped straight into the deep, but everyone says we have AI this, we have AI that, we're AI shipping company or AI something. What that usually positions you in is that when you, and it really resonates with Iliya's point, when you say you're an AI company, investors also expect AI growth rates. And those are skyrocketing. And it's not just having the feature, it's having all the KPIs behind an AI company to really back it up. Otherwise, you don't meet the benchmark, basically.
I think it's very important to differentiate what AI company is, because for me, AI company is the LLM, the company that is actually doing, the analytical part behind, and everything that is in front is just a use case for the AI. So it's not like you say, I'm an internet company. What the fuck does it mean, right? So you need to basically either do AI as a business model or use AI in order to achieve certain goal. And most of the AI companies today, especially the companies that you're mentioning, they're just using AI in order to achieve certain goal, but they are not AI companies. And maybe you disagree with me, I don't know.
The definition changes every 3 months, so it's very hard to pinpoint it. To me, it's all the LLMs, they're already built. So companies that are building LLMs right now, they're uninvestable because it's too late.
Yeah.
So the question is, what do you do with these things? And then, the next layer was this infrastructure. So hardware is out of the question. You should have started 10 years ago, right? So then you have the LLMs, you have the infrastructure, and actually a lot of the value is in the application layer and the applications. But the thing is, what do you do so that you're not a feature that somebody can vibe code in 1 hour in Cloud Code, for instance? So it becomes this software system which can do many things. And to me, these are agents, agentic workflows, stuff that are computer programs that are doing stuff on their own. They're powered by LLMs, but there's a lot of value in mixing and matching them right, I would say.
Which is actually very interesting. Let's get back maybe to the funding.
Funding, but actually this is really important topic. AI and as this horizontal layer that each company at some point integrates some kind of AI solution, especially if they want to be scalable nowadays. But in terms of funding and scalability, how they really differentiate and what is the real competitive advantage? How?
You mean for AI companies?
It's a very hard question.
It's a very hard question. Yeah, that's why maybe worthy brainstorming. Not necessary, but
when it comes
what will be the competitive advantage when speaking about the real competitive advantage when speaking about AI as this horizontal layer integrated in different kind of companies?
To me, so for our business, the thing we're building an AI agent for marketing teams. The only thing which is defensible for us is speed. So we need to be faster than everybody else. And this is kind of true for all the companies that are breakthrough companies like Lovable, Cursor, Manus, all of these success stories. our product can do the same as them just 6 months later, right? And they were much faster than everybody else. So this is what the breakthrough AI companies today, they are much better in speed. Now, for businesses that they have some other advantages, which are maybe some data, maybe some access to something, over there you can find some competitive advantage. But in these 66% of the companies that got funded, probably 65% didn't have any competitive advantage whatsoever. And they were only, saying what we were saying. We're faster and better than the others. 10 years from now, we're going to build a bigger business than everybody else. And
okay.
Yeah.
And speaking about AI in different kind of industries, in your opinion, which industries are really trendy right now, and which ones will remain trendy in 2026 or the upcoming years? Fintech was one of the most hot industries till recently.
We had
like
fintech, then we had ESG, then now it's, for the last few years, the really hot topic, at least what I'm hearing from investors, bringing it to the fundraising team, is AI so far. Maybe next year I'm actually expecting to see much more robotics, so applied AI and biotech. This is very speculative, but actually it's very speculative, but probably backed up with a little bit of reading behind it. If you guys follow some of the research that comes out on the public markets, there's the ARC Fund, led by Cathy Wood. They do this really cool report every year. I think it came out like yesterday or last week or something. It's called Big Ideas 2026.
Okay.
And you get some of those big things that they think a lot of capital would be deployed. Of course, I'm making an assumption and a reference here that the public market is somewhat reflective to the, the private VC market, and they're intertwined. But yeah, biotech, autonomous cars, robotics, I think are going to be probably the next few.
Defense is actually hot now.
Defense, of course, with the instability around the world.
I'm in this group, which is some private group with founders, investors, whatever. They were talking about different trends for quite a while. For the last 3 months, it's only robotics. There's not a single topic which is not robotics. Somebody brings up AI and then everybody is back to robotics. And it's kind of, the feeling is that the AI companies, many of the good ones have been discovered, and the arbitrage is somewhere else. And robotics is a good bet.
Yeah.
Any final thoughts on the funding markets, key trends, before we move on to the next one?
I actually have one thing that I would like to say. Every company is good at certain price. So you can't really get around, it's a hot topic, but at the same time you can go and invest even into like a legacy industry. And if you find a company that is good enough and at the right price, you can still invest and you can still make money. And some funds do exactly that. So I think AI is a hot topic, but also AI is overinvested massively. So you can't really say that AI is so hot at the price it is now.
I'll probably mention another thing that I think it's good to share with the listeners, and this is that we're seeing also an uptick of IPOs, M&A deals for the last few years, which I think were in their low in 2024. So they're upticking for the last year, which in essence means that there's more money in returns coming from the previous generated or invested deals, which allows LPs to back up more VCs. So we're getting a bit of positive signs around that. So that will be probably good for the next 2-3 years, seeing more funds being deployed around more risky capital like VC.
Okay. I absolutely agree with you, and it was a very big problem that the money was locked up before the IPOs. It is an exciting concept, an exciting trend. Just wanted to double that.
Amazing. So now we're moving on to your personal fundraising journeys, actually, and I'm interested to know what's behind the scenes, because each success story and big rounds and etc. They're published. You can find information on the web and etc. But what actually happens behind the scenes and the personal struggles, challenges, successes as well, they're not so easily known for the audience. So share with us how your personal journey in terms of fundraising went. And Konstantin, we can start with you.
Okay. Well, I would say that with a personal story, we started, it's interesting for us because we kind of bootstrapped the company up until about 2023. And the reason for that was
Maybe you can share the year that it was founded, just for reference for the audience.
We went commercial in 2018.
Okay.
So that's, we went commercial in 2018 and we bootstrapped up to until about 2023. The reason why we did that was we wanted to see a clear inflection point, which makes investing external money actually having its value as it's supposed to do. So it's a clear understanding or agreement in our case that getting external investment shouldn't be something for you to survive. It should be something for you to accelerate an ongoing working engine. So we saw a very clear inflection point backed up with the changes of regulation, changes of market, clear customer signals. And we said that this is the time when it makes sense for us to bring in external money. The way we decided to do it, we wanted to do small round at the beginning in order to see what the result is. So very much like an experiment. Does money in mean output out? And when we saw that it works well and the company, the team, we as a team can digest that, we said, okay, it makes sense to repeat that motion again. As a personal story, I would say you have to treat the fundraising process very much like a sales process. So you have to have the funnel, you have to have the different stages, and you have to, it's not a random event whereby you're walking somewhere and you bump into someone in the coffee and they give you a suitcase of money. So it has to be a very, very structured process. And that's probably one of the stories I would like to share about our.
How much have you raised to date? Sure.
About
Around
12, 13 million.
12
or 13, yeah.
Across 4 rounds.
Across 3 primary rounds, and we had one closed deal at the beginning, which was a convertible, but we've paid that back. So the company is profitable to pay it back.
So this is across, so it took you 3 years to do about 4 rounds?
3 rounds.
Okay, so you're doing one per year, or is it like, is your next one coming this year?
No.
How are you thinking about this?
No, I would say it's a learning mistake probably. I was gonna keep that one in the mistake section, but it's good to raise, in my opinion, and what I've seen as best practice from other operators, is good to raise for about 20 to 24 months in advance. Given that we were doing this kind of experiment I was talking about earlier, we just didn't raise that much at the beginning as we were needed. So we said, okay, let's double it down. Of course, this comes at the price, the experiment, and this is, you kind of do double the work, triple the work.
Your time.
Yeah, my time. And you need to keep shipping, you need to keep the customer satisfied.
You mentioned the funnel. How was the outreach organized? To how many VCs did you reach? How many conversations did you have? How many close connections before actually closing the round?
So I'm a big believer in prepping before a fundraising round. So definitely you shouldn't do it when you need the money. So you should do it at least 6 or 7 months before. I was actually prepping for a round, for a bigger round all the time. And this is through networking. I've been leveraging, going to events, connecting to investors on those events. And I thought that's been a kind of good place to meet people. And it's not so much to, for them to get to know you, but also for you to get to know them. And so I can share with you some best practices and some KPIs that I've read recently through I think it was PitchBook. They were saying that for the average seed stage company, they do about 77 conversations with investors, which result in about 24 meetings, which result in about a handful of term sheets and one deal. So if you
for how many months do you know?
I think the average for that seed stage, because it depends on the stage, is about 13 weeks. But this does include US data, so we have to be careful about that, because
usually the process in US is quite faster.
Much faster, yeah. So if I want to be prudent, I'll probably double it for a European fund.
The data I had 2 years ago was 1 to 6 months is the average time it takes for a round, with a median of 3 months, so 13 weeks, as you said. However, in Europe, it's usually 9 months. So basically, it takes us much longer here. In our process, it took 20 days from the first meeting to a deal. 20 days. With the final investor, the whole process took 6 months.
Okay.
But it was in the US, to the point that the deal is moving very quickly, right?
Also, it depends US and Western Europe versus Central and Eastern Europe. So it's quite different. Stu, maybe you can share your personal journey, but just a couple of sentences of the company. What do you do? At what stage are you? What was the round and the journey?
Absolutely. So the company is named Paypercut, and I'm the CEO of the company. And what we're doing is card acceptance and BNPL aggregator for Central and Eastern Europe. It's a pretty unique product because it's something that exists in other markets, except the BNPL aggregator that is quite unique. This product exists elsewhere, but it's just not that good in Central and Eastern Europe. So we just decided to take a product from Western Europe, tweak it a little bit, and basically localize it for CE. It was funny because I left my previous company at the end of September. In the middle of October, I got bored just to do nothing, basically, and went to London. I met with some of my former friends that are also investors, partners in VCs, and they said, Stoil, we know you for so many years. We're going to back you. Why don't you start something? Of course, I had an idea.
So it happened the other way around.
Easy. Yeah. It wasn't that easy because it sounds, in theory, it sounds very easy. But they, of course, didn't write the entire check.
So you have UK investors from the beginning?
Yes. We actually don't have any investor from Central and Eastern Europe. Maybe the place that is the most east in the map is Germany, I would say, Munich. And it's just the investors that I knew from the past, they were more like Series B and after investors, and they invested very little. So we still had to go through the whole funnel. You're absolutely right. You have to do the preparation. You have to do like a very large funnel and then follow through with it. We spoke with over 80 investors. At one point, we ended up being 2 times oversubscribed. And if you're 2 times oversubscribed, you're thinking, I'm actually making a bad deal because obviously the price is too good, right? We decided to upsize the round a little bit, but then we decided that we don't want to take more money. But I can say that there was a time just between Christmas and I would say 15th of January when I didn't know if we'll be able to make it. Because, we had the larger investors ready to come and back us right now with small checks, and then they want to be in for the larger checks if we need them at one point. But still we need to find the lead investor that is going to lead on a pre-seed stage, which wasn't the easiest thing. Ultimately, we managed to find such fund, and I'm super happy with the outcome because the fund is absolutely amazing. Actually, the 2 funds that led the deal are super amazing, and they're trying to help me. It was very hard because my co-founders, they're different type of people. Emil, he's a sales guy, and Gareth, he's a compliance guy. So for me, I had to do everything on my own without anybody to, go after me and double check the information and, challenge me on some of the things that I was making. So honestly, I was using friends to ask them questions. What do you think about that? How do you feel about that? Does that resonate nicely? So all of these questions I was asking to friends instead of to my co-founders.
Great. And can you share for the audience the final amount that you raised?
2 million euro on pre-seed round.
Thank you. Iliya, your fundraising experience?
Yeah, we raised 4.5 million US dollars. And I've documented all of it on Ilia.ai for anybody who wants to read it.
Just a couple sentences of the company.
So yeah, super. So we're building Juma. It's a marketing super agent. Basically, people can chat or use their voice to do any marketing task with it. They can connect their data sources. They can create assets. They can analyze data. Create ads, manage their ad campaigns, whatever. Anything which is marketing can be done by the agent. When we fundraised, I was basically thinking this, that we have to raise for 2 years in advance. So it's a very big round. At the time we raised, it was the biggest round, biggest seed round for a Bulgarian company. But the thing was, we were bootstrapping, same as you. And one day I see that all of our competitors are now funded with like $3, $5, $10 million. And we're like, okay, we can't fight with this. It's impossible to build a business and remain competitive 6 months from now when everybody is raising. And the problem is not that they raise 3 million or 5 million. The problem is they're gonna raise 20 million in like 1 year. And so we decided to fundraise. One of the big changes in my mentality was when I met Bogumil Balkansky, and he told me this is investable, and you can build $1 billion business on this vague idea and direction that you have. And we decided to do it, but kind of the market forced us to start thinking about this more seriously. So we started from Bulgaria, but the calculation was such that so we needed a lot of money. In my calculations were anything below $3 million is not going to be enough to try to build the thing we want to build, given that we have LLM costs and all of these things. And in Bulgaria, this was too expensive of a deal. Nobody wanted to back a deal like this. And then I went to Europe, and the deal was doable, but still uncomfortable, let's say. And when we closed the deal in Silicon Valley, this was the exact average seed round. So it was nothing, out of the ordinary over there. But yeah, we kind of started from Bulgaria, Europe, went to the US, and this is where we kind of found partners that understood the vision that we had and wanted to partner with us.
Amazing. And what was the funnel in your case? Do you have some numbers?
Yeah, 85 rejections. So about 200 meetings, something like this. But to me, the process was this sales funnel where I need to force them to say no. So I'm going to push them in the meeting, and I'm going to be like, how do you feel about this deal? Do you want to invest in this deal? If they are dubious, I will never call you again because I don't have time for this.
Waste time.
Yes, and I was really optimizing this for who is actually excited about this deal. If you are, why don't we do the deal? Each day that is passing is hurting our business and potentially their investment that they're going to make.
And how long did the process take?
I did 2 months full time. So for 2 months, I did not work on the business. My co-founders were mainly working, and I was full time fundraising for 2 months.
You managed to find investor and sign a contract for 2 months.
Yeah, I started reading books in, say, January. I prepared all the materials. As Tino said, this is crucial to have everything prepared. I was preparing until the end of Feb. And then on the 22nd of February, I started kind of this journey, London, and then US, and so on. And it took 2 months of full-time meetings, 15 meetings per day, every day, until it got done. And yeah, we signed somewhere in May, and then we received money in the bank in August, end of August. So, it's a long process.
And also the other point that I want to bring around the long process is within this when you start speaking to an investor, okay, you send them initial data, you send them a pitch deck, or they ask you for some high-level stats before they dive deep. What happens is you click on the timer, and then the longer you stay within that process, the higher the probability that things are not going to go well. Because every single month or every 2 months, they're going to ask you, okay, how's the business doing? Give us a recap, give us an update of what's doing. And it's important also to kick off that process. It's important not to do it after, let's say, you've had a bad quarter. So if you have a bad quarter, this will be, on day one, you'll be losing negotiation power against that investor. So the moment you want to fundraise, make sure that the sky is clear and you can take off for a flight, and you have some really good things that are coming, and you're going to have a bunch of hidden cards in your pocket that when the due diligence process goes through, when you continue building that relationship with investor, you can come with pleasant surprises rather than unpleasant ones. Because probably in order to get interest from a VC, some founders might try to, say too much of a big story or expose everything that is really, really good about their business. And from then on, they're only open to just saying, it's okay, we didn't grow that much this, or we churned a bit more than what we expected, and so on and so on. And it becomes like a bad process.
So you raise capital when the company is in good state?
Yeah, when the sky is clear, that's when you take off.
Or before it has started. This is a good time.
You know Silicon Valley, the movie where the guy was saying, you don't generate revenue. The moment you have revenue, you're already, you have multiple. You don't want that. Right? No, it's funny, but actually the process always takes a lot longer. I knew what I'm doing, I had the investors, and yet I closed only at the end of March. I had the final allocation done by the end of January, but then you need to register a company. Where do you choose your holding company to be? How do you then move money from one place to another? We are a fintech company. For us, it's super important how we move money efficiently. So all of these things, they come into play, and actually you have to think about all of these things, ideally before you go and fundraise, but sometimes, while you're fundraising, because, that's going to become a problem after that.
Did you ever walk away from a deal that was good on paper?
I did walk away from a deal just a few weeks ago. There was a fund that came and they wanted to give us an offer. It was a small offer. It didn't help us much. It was still a good offer in terms of valuation, but at the same time, small amount of money. And I decided that this is going to be such an unstructured process that is going to cost too much of my time that I have to allocate to run the business than to actually fundraise.
Good. Did you have such cases, walking away from a good deal?
Yeah.
And why?
I walked away, and I would walk away again.
Why?
And
What happened?
Well, it's not what happened, it's what didn't happen. So closing a VC round, following that whole philosophy and strategy that it shouldn't be about survival, it should be about accelerating something that's working, means that when you get into a partnership with a VC, it's a long-term partnership. Otherwise, you promise a bunch of things just to get their attention. Okay, you might get away with it, even though most VC investors are very experienced operators. They see a whole bunch of companies. And then you pose yourself up for disappointment and a not very pleasant journey after that. So the money that comes in need to be seen as a long-term operating partners. And unless you have alignment on strategy, on how this business is going to go and how you guys are going to exit, then this is not the right partner for you, in my opinion. Sometimes a VC might come and give you a spectacular valuation. Usually what I've read and seen from other founders is that those come along with spectacular problems afterwards. So be very wary about who you choose. You might choose an operating partner, an operating VC. These guys help you fix up some parts of the operations that you're not good at. So you might be a technical founder and you need an operating VC partner to help you build your go-to-market strategy, or vice versa. You don't want just the money, or sometimes as known, the money investors. You want smart money investors, and you need to know what do you need in order for me to accelerate, and that's what you should seek in the partner.
I have a comment here. A lot of founders, they come to me and they speak about fundraising, and they're saying, I got these investors and they're not adding value. Yeah, well, like if you don't have an idea how to run your business, then no investor in the world is going to add value to your business whatsoever. So you have to actually know exactly what you're looking for, exactly how to line up things, and then go and ask the investor what he thinks about your idea to validate it, and not ask him to actually do the job instead of you.
Oh yeah, completely agree.
And some people, they're delusional sometimes when it comes to the value that investors bring.
Mm-hmm.
One of the things that they gave me as advice was to have a slide which is with the perfect investor. And our slide was basically we were looking for 3.5 million. This was the target from investors who were ex-founders, so they had founded businesses before, and there were a couple of other stuff. And then when the wrong investor looks at this slide, they're like, this is not for me. So we repelled them, and we didn't even lose time with them. Mm-hmm. And all the founders were like, this guy knows what he wants and what he's looking for. So our board member that got on our board, he was an ex-founder, turned CTO of Twitter, and then now VC. But this was super important for us. And in the next rounds that I'm planning, I'm now very focused on who is the next board member. Because after a seed stage, so currently we have control of the company, me and my co-founders. Next round we lose control of the company. It's gonna be me on the board, Mike, who is currently, and one more person. We lose control. Who are we losing control to? Yeah. They need to be smarter, better, more experienced, more, just very, very experienced in what we are doing. And to me, this is one of the most important things when looking for a partner.
And probably have the same vision for the company for the future.
Doesn't need to be the same, but the right partner will say something like, this is your company, we believe in you, but these are our concerns, and this is what you should be looking at.
As advisor.
They would never tell you what to do, because we are in the nitty-gritty of the companies that we're building, and they're not. So they can only be a sounding board. They can kind of give some sort of advice, but they cannot tell you what to do. And if they tell you what to, we're going to do the opposite because we're founders and we know our vision for what we want to achieve.
Actually, in my previous company, I was responsible for fundraising. And together with the two co-founders, we actually started to speak with a large private equity, one of the largest in the world. And these guys, first 3 meetings, they were absolutely amazing. They knew what we want to achieve. They wanted to back us. They gave us attractive terms, and then they started to do the diligence. And then you can see that actually these guys, they were more interested in optimizing our business for short-term profitability versus long-term vision. And that's a problem, because then you have misalignment. Now, the moment you confront them and you tell them, hey, folks, that's not my long-term vision. If I become profitable right now, I won't be able to reinvest the proceeds to actually achieve what I want. They are always saying, no, that's not what we intend. But actually, you kind of have to sniff these things out and then turn down a deal sometimes because it can become a problem. And my the founder of the previous company, he had that experience. He was the co-founder of PaySafe, and he got bought by private equity, and the whole thing actually fell apart.
So this leads me to the question, how do you choose the right investors? And are there any signals that an investor might be wrong, even though the money is attractive?
I can tell you how I choose investors. It's not by the book, for sure. I think like it's super important that you feel comfortable for these people to sit in your board. Like that's the test I'm making. And of course, you know, that's something you also alluded to. But for me, it was super important that I feel comfortable with these guys, that you know, they don't confront you for every small mistake, every small problem, you know, every small issue that they find. I've heard horror stories about founders, you know, spending time with auditors sent by the investors instead of running their business. And for me, it was important that, you know, people actually understand that you're innovating, and while you're innovating, you're going to make mistakes. And then, you know, if they sit in your board, and especially if they have the control over the board, well, this can be really bad for the company. I think there are a few cases in Bulgaria for companies and founders losing control over their companies, and after that losing the companies because of this type of investors. So, but for me, it's more of a gut feel. It's not like I don't have a checklist.
Choosing the right investors.
Yeah, I very much resonates a lot with what was mentioned, and I would say probably for someone who doesn't have that good feeling because probably they're doing their first startup or they haven't done any deals before, it will be good. One trick that I've done in the past when I was doing my first rounds is the investors that I think I want to do a deal with, I start speaking to their portfolio companies. Okay. So I'll reach out to, let's say, a deal that they've done, a recent one, a mid one, and a long-term one. I'll reach out to the founder, to the CEO. Usually, as you guys know, the ecosystem of founder to founder mantra and mentality is super, super strong all around the world. So founders help each other. So even if you reach out over LinkedIn, even if you don't know them, cold outreach, ask them, hey, can I get 15 minutes? I'm speaking to these investors. I really want to understand more about them. So make sure you diligence them just as hard as they diligence you and your business, because you want to know, are you going to fit in terms of culture? Are you going to be comfortable to run the company through the board together? How are they going to behave in a stress situation? So that's very important. If things go bad, what do these guys do? Do they send the auditors, or do they come and give you ideas based on them being more experienced? What Iliya was saying earlier.
Good, but did you have some negative responses from them? Because people tend to be polite or politically correct and etc. So what did they say to you?
No. Generally, founders are pretty open, I would say. Okay. It kind of comes with the mentality. You know, everyone might be a business founder, a technical founder, but the one thing, the overarching not skill but characteristic that comes through all of them is that you're pretty direct when you do that. When you have 100 things running in your business and there's a fire that you need to take out, even if you decide you want to spend some time to pay it forward to someone, you're not going to bullshit them. Okay. So I haven't had. Sometimes they might not answer, but I would say in my case, my experience, that has been like 10% of the cases. Usually everyone follows. You
got honest responses.
Yeah, I would say people say, yeah, these are bad here, don't talk to them. Okay. I don't want to. They would say, I wouldn't do a deal again with them, or they did this in that situation, and so on. But hey, it happens. Horror stories in startup world are a lot and very much not publicized.
This is very true. I often close deals for my investors because when they do due diligence, somebody writes to me and I like them so much that I'm gonna give the 15 minutes every time to tell some other founder, this is the right investor for you. We have one investor which is very hands-off, and we have not talked too much for each other. I cannot recommend or not recommend this investor because it's multiple investors, right? And I would rather dodge the call, right? Because I'm not sure what to say in the street. I'm not going to add any value to this conversation. So if somebody gets on the call and then they recommend and they give this time from them, it's an extremely positive signal for the investor, I would say.
That's a really good, it's a signal as well. If they don't take the call, if the founder doesn't take the call, it's a signal. And also, by the way, you can use a little hack where you talk to portfolio companies, also asking and due diligencing the investor, even if you haven't spoken to that investor before. Sometimes those calls turn out into an opportunity to get introduced. And the strongest introduction that you can get to a VC is through a founder. If they've entrusted them with 4 million, they would trust them for a recommendation for a
Good
nice
point.
CE business.
Nice hack.
Yeah.
Okay, so let's talk a little bit on the mistakes along the way that you've made, or something that probably you wished you knew back then, something that you want to do again, and some challenges that you had. Iliya, maybe we can start with you. Share us your biggest challenge while fundraising.
In this way of trying to reach truth super quickly, I've been extremely direct with VCs, and this was not very helpful, I would say. Yeah, so you go, you really say what you think, and this backfires because it doesn't fit the VC thesis, it doesn't fit the spreadsheet they have to put you in. You have to think like a VC in the process. You have to say the right stuff. They want to hear some stuff, and even if they're the right VC, if you get into one of the wrong buckets because you didn't say you want to build $1 billion business, and we all VC funded founders, we want to build $1 billion businesses. Final, we want to IPO, we don't want to exit, and so on. These are the right answers, and if you don't give them, you give the wrong signal, and you don't want an analyst who just joined the fund to write down that this founder doesn't fit the bill, right? And then you don't get the next meeting. In the beginning, I didn't understand that. I was very truthful, like true to who I am, right? Later, I was a bit more, strategic. Let's put it like this. I would say I blew some meetings, but it was a learning process at the end of the day. There are right answers to every VC question. So I would say 90% of the questions VCs ask, there is a right answer that you have to figure out, memorize, and just say it.
It's a fine line, actually. Being honest and
I would say there's a way to know if you've done the final answer, the right answer, and it's the whole idea about a VC process is basically you start at the very beginning of a relationship with a whole bunch of questions that they have. And throughout every interaction, those questions need to, boil down to the single question. Am I investing in this or am I not investing? If throughout the conversations you're opening up, you're giving information that just is not clear and they do not understand it, it's going to boil up into, opposite the inverted funnel. And that's how you know that you haven't given out the right template answers.
A good one.
But also in that reference, usually VC wants to know that the company is scalable and that the founders are ambitious and etc. So usually, as per my perspective, I see that a lot of founders are a bit not shy, but let's say not so ambitious compared to their peers from US and Western Europe, scaling big, dreaming big, putting themselves out there. So I think this is a local trend as well, actually, when speaking to investors, to be more self-confident and ambitious, that actually you're bringing this company on the next level and you're going to scale big. My observations.
In the US, especially, you have to be the best thing they have ever seen in their life. Confident, like aggressive and all of these things. There's a good stuff. In Europe, it's not necessarily. So if you're not a bit humble, this backfires. So you have to be, confident but kind, aggressive but humble. You have you have to show all of these sides of you in 30 minutes because we're on the clock. We're all busy people, right? So you have 30 minutes to show all of these things, and it's kind of theatrical in a way.
Confident in the same way.
Come again?
Humble and confident in the same way.
Exactly. In two different situations within 30 minutes, and you need to explain the product and the vision and the stuff, and that you can hire people, and that people like you as a leader, and that you can sell your product. All of these things in 30 minutes. So you cannot wing this in the sense of there is some theatrics, there is a lot of preparation, a lot of experience. You just have to, and when you do it 15 times per day, on the 15th time, you don't have the emotion in you to do it, and you're still doing it. You're still excited about everything you're doing, and it's what it is basically.
But also, it's a filter for investors. Like if you're presenting to them, if you're showing them exactly what you intend to do, you have a blueprint, you have the steps, everything is lined up, and they want you to give them the right answer. For me, it's a filter, because like if they don't understand what I'm doing and they don't back me on the steps that I'm saying that I'm going to do, they don't fit in my cap table, so they probably don't belong there. And it's better for me to tell no than to actually say yes, invest, and after that realize that they have invested into something that they don't even understand. So I think, you cannot play that game forever. You kind of have to at one point like review your true self, and like if they don't want to invest, that's fine.
I think one of the OGs was actually saying something similar about investing, that the process, because people sometimes complain, startups complain, oh, you have to have that right network. I mean, in your case, you had the right network from day zero. You have to know the right people, then you have to get in those meetings, and you can't just, come out of the door and knock at someone, and it's very low probability. There's a saying that this is the first test for a VC to a founder. If you can crack that first ticket, that first connection, plugging into that world, you can hustle enough through the problems that you're likely going to meet throughout your operating your business. So it kind of resonates with what you were saying.
That's exactly right.
Yeah, and I just want to say on top of what I said before is, I believe the first meeting is to get the second meeting, and that's why the first meeting is so important to show all of these emotions. And I think by the third, fourth meeting, you can be your true self already, but I think in the first 30 minutes of when you meet a new person, you can only do the first impression once, and that's why it's so important and different than anything else.
The question is then, when do you start the fundraising process? Because for me, it's a lot longer process. You're building relationships, you're captivating these relationships all the way through until you actually are ready to present them the deck. So they should know your business already. They should know you. I spoke with a fund from the Middle East many years ago. And I remember the guy, he was a Hungarian partner in this fund. And he basically told me, the first question I'm going to get asked is, how long do you know this person? And if I can't answer at least 3 years, they're not going to even listen to me. So it is very important to start building these relationships early on, because then actually that converts into a quick deal. Otherwise, you can go through cold calls forever and you're never going to get anywhere.
And Stoil, this hits exactly with what I've been seeing and reading, because I've seen from, again, various sources and analysis that the number one mistakes seed companies make is actually starting too late. So they really underestimate how much the process takes. And part of the reason is it's not really widely publicized by founders. There's not many of those stories saying, hey, I started the process on this date, it took me X amount, like we're doing it here. People only see the result, the headline. Yeah. Oh, this company raised that amount of money by this investor to do this. And it just sounds like, oh, it happened from one day to the other, exactly. But it's taking much longer time. And it's the really big mistake.
It's not a secret anymore, I guess. We are preparing a fundraising round already because our business is extremely capital intensive. We need a license, we need to check a lot of boxes for the regulators and so on and so forth. So we are now working to prepare all the documents. But I already have like a list of 10 investors with whom I've been building relationship for the last year, so that now when I go and knock on their door, they know exactly what I do. I don't really need to pitch to them. They're just going to very quickly understand what we have built, where we failed, and whether that fits their investment criteria. So I think this is going to be, I would say, easier with them at least than anything else.
I can share another little hack that I think works when you do these. What I've done is all the relationships that I've made with investors, I put them in a database, literally like a CRM. Yeah. And what I do is I always ask them at the very beginning, in the first 15 minutes meeting at the end. Also, it's a good signal if you liked each other. I get their email and I say, do you mind if I send you regular updates about the company? It's not going to be investor updates that I send to my investors, but it's just going to be, hey, this is what's happening, this is what we've built, this is what we've shipped, this is what we're seeing is looking good. And by the way, here are my asks. And there's usually 1, 2, or 3 asks that I have to that wider network. it gives me a preliminary signal who reads those, who answers to me. And you again be surprised about how many of those investors actually come back to you and they'll say, hey, for instance, one of my asks recently was, we're hiring for these positions. Do you have either a good candidate that you can suggest that you've seen throughout your businesses, or can you suggest for a good executive recruiter? I had an executive recruiter already. I just wanted to see who's going to respond. So that's a nice little hack. And I've called the newsletter Friends of Evrotrust, so you can guys template that and use it.
I send them the full investor reports.
Okay.
But we build in public. All of our data is public, right? So is there a reason why I don't send the actual updates?
Yeah. So the reason that we don't send full investor reports is that, again, two reasons. One is I don't want an analyst who might get that email to really box you into something and you get a knee-jerk rejection maybe somewhere because they might have not understand something. And second, there's also proprietary information that I share with my investors. So it might be about strategy, it might be what product we're building, some initial signals, some wins of clients. That data should be kept confidential, in my opinion, regarding, because we're doing enterprise deals. So it shouldn't leak out to potential competitors and angles of differentiations that we're building.
So any challenges what was your biggest challenge when fundraising, and maybe you can share a few lessons learned?
I guess the biggest challenge was, it's a sales process, and every salesperson knows that you have to learn how to accept no, because oftentimes you get these no's. And sometimes you get discouraged by that. You're saying, am I doing something right? Am I not wasting my time? Why am I doing this? And that's a very hard mental challenge for every founder, to hear these no's and to still continue. So I guess that's the hardest thing. And then the other challenge was, I ended up with a few offers more than I expected from funds that I like.
It's a good challenge.
It's a good challenge, but it's very hard to tell some of these guys no, even though you know that that they're never going to come back to you, just because it's already going to be too late at the next round for these guys. And they can add value, but you need to find the people who can add the highest value, and you don't know that. That's unknown from the very beginning. So you need to guess a little bit, and that's also hard.
Yeah, we've also had similar problems where people want to join the round. They might be not at the appropriate stage. They might be a bit smaller. They want to write smaller tickets just to join. They really like the company. They can add value, but they can't. You have to say no to them. Another thing that I can share about a mistake about getting the no's, and I fully resonates. You might get discouraged, but you need to be very stone cold and see it as a sales process. Okay, there'll be 80 people. I only need one term sheet at least. Best to get like multiple term sheets. One thing that I do as part of my funnel process to the investors that I like only is when we get a no, and again, this is another one of my little tips and tricks that we do, is if I like the investor, I know that they like the theme, the topic, the industry that we're investing in. And we might not be the right company for them right now for multiple reasons. They might not like that we're from CEE. They might not like our traction. They might want to see us at another stage or with different parameters. I usually offer them availability to reach out to me any point that they would like, just as an external advisor. I say to them, we play in the identity space. I say to them, okay, I see you like identity. You might be looking at a whole bunch of other companies. If you want to just exchange notes about the market and, cross-check some information that you're getting, and if you feel that, I can add value, always feel free to reach out to me, and I would love to spend some time with you. And to your surprise, there's actually a bunch of VCs who are regularly talking to me about the identity space, not for us to invest in us, but actually to evaluate the other companies on the market and to just see how we're seeing the market and to gather a bit more intel. It's super, super valuable for the investors because they generally don't have, unless they're really big, they generally don't have a whole bunch of specialized advisors, and for them it's very expensive. It's usually part of a commercial due diligence that they might do. So if you can offer that value to them, it's always a nice way to help out the ecosystem.
Absolutely.
Not even to look for something in return.
Good. Any final notes, something that you would like to share? We have a couple more minutes left. Some lessons learned, mistakes made, general advice, anything you would like to share? Then we'll try to do this little game in the end.
Something that I very often see, Bulgarian companies, Bulgarian entrepreneurs and founders, they consider investors as, higher beings. And, to everybody I say, you're not getting a new boss, you're getting a partner. Mm-hmm. If you can't partner with these guys, if they treat you as if you're their employee, mm-hmm. they don't belong in your cap table. I think it's super important that everybody understands that, and also the VCs understand that, because I've heard the VC saying, if I call this guy at 7 in the evening and tell him tomorrow I want this report on my desk, he's going to work all night and produce this report. And to this I say, F you, right? I'm not going to deliver this.
I would say that the one thing that we didn't touch upon, and it's really, really important for the people that listen, is we spoke a lot about how to get deals, how to negotiate throughout the process. After the term sheet and when you start doing the closing documents, all the details and all the devils are hidden there. So for founders, be extra, extra careful about the terms you agree to and make sure you don't optimize for valuation. There's a famous VC saying, you can write the valuation if I can write the terms. It's all the details are there. So be extra wary. I know sometimes it's a legal lingo that you might not want to go into, and you just care about, it's 10 million at 200 million or 100 million valuation. That's it. I'm signing on the bottom. You shouldn't do that. You definitely need to understand what are liquidation preferences, how is the company going to be governed, how is the board going to be maintained, what kind of operating capabilities you're committing to. When are you losing control? What Iliya was saying, these are really, really good nuggets. So make sure you pay attention to those terms.
Would you accept lower valuation for a better partner?
Yeah, for better terms, for sure. For sure. And we've done that before, You don't optimize. Chasing valuation for headlines is a lot of ego. Chasing the right valuation with the right partner, what we've been discussing here on the roundtable, is the way you add value to your shareholders and you as a shareholder as well.
There is a great book called Venture Deals that every founder who seeks venture capital should read. All of these things, I was going with the book in my backpack, and every time some VC drops this in a call, I'm like, yeah, whatever, and then I take out the book and I read it because I have no idea what it means. And then when we got the term sheet, I finally got the term sheet in one hand, the book in the other hand. I finally understood what these things mean to me, and we changed two of the terms in the end because it's allowed. A term sheet is
negotiable.
Negotiable.
Did you have an advisor?
During
the fundraising process or the term sheets?
Many advisors, in the sense of, talk to founders that have done it. They are the best advisors. Nobody else matters to me. And not matters at all, but, people who have done it in the last 3 to 6 months, they know what it is right now. I don't know what it is right now because I fundraised 2 years ago, right? So.
But also investors don't like advisors. It's a red flag for them. If a company comes, you're a pre-seed or seed round, you're trying to raise 2 million and you already hired an investment bank to run an advisory process for you. No, that's already a red flag. That only shows them how you're spending their money. So you don't do that.
There's the formal advisors, what you were mentioning. Yeah. I would say that you can use what Iliya was saying, other founders, other operators as external advisors, just to check your notes. And those should stay in the background. Very much agree. It's a really red signal if you come in and say, speak to my advisor. He's running the process. Yeah. Right?
There is nobody who can give you like millions. Without really understanding what the founder is up to and not the advisor. In SumUp we used Goldman Sachs and JP Morgan and a few of the other guys, and I can tell you we never rose money without really getting Daniel, our CEO, on the phone to speak with the investors. Ever. Doesn't really matter who is your advisor.
Okay, good. So let's finish off with this little game. I'll start a sentence and I ask you to finish the sentence. So, first one fundraising mistake every founder should avoid.
is to go unprepared, I would say.
One fundraising mistake every founder should make is to optimize for valuation.
Okay.
To me, the biggest fundraising mistake is to work with someone, with a VC which doesn't treat you with utmost respect. They need to respect you, and you need to respect them.
Mutual respect. Okay. Next one. One thing you should decide before talking to investors.
Why do you need the money?
One thing you should decide before talking to investors.
What does my ideal investor look like?
The investor profile.
Yeah.
Am I ready to commit to this business for 15 years?
Good. And the final one, finish the sentence. A good investor is?
Let's circle back. I have a good answer. Or at least I don't have an answer that is just going to complete the sentence.
I think your answer is a partner, actually.
Yeah,
Let's
circle back.
And the final one. A good investor is?
Yeah, I was going to say the same. True partner. Like, that's it.
A good investor is?
A good investor is convicted when it gets hard, and he or she is constructive when it gets messy.
I second everything that these guys
Good. Thank you very much for this conversation. I think it will be really useful for companies that are looking to raise capital in 2026 or the next few years. And it's an evergreen topic, so thank you.
Thanks so much
Thank
for
you very
inviting
much.
us.
Yeah, thanks guys.
The Recursive RoundTable. 3 voices, 1 idea to decode the future.